hedge fund manager called Victor Haghani presented a TED Talk entitled "Where are all the billionaires and why should we care?" Given there were so many millionaires at the start of the 20th century, Haghani says there should be far more billionaires today. After all, in that time, financial markets, particularly stock markets, have risen hugely.
The basic thesis of it was saying that if investors were able to get the returns that they ought to get, we should see a lot more billionaires in the world today than what we see. Now, I'm not saying that that would be a good thing to have a lot more billionaires, but the thought experiment was to show that investors must be getting a really poor share of the return that they should get by the fact that we have so few billionaires that exist today that should exist based on how many millionaires there were, say, in 1900. And so it's this thought experiment that's really proving, maybe proving is a little bit too strong of a word, but helping us to think about just how poorly investors have done in terms of capturing the returns that they ought to.
So you might be wondering, why aren't there more billionaires today? Well, Victor Haghani puts it down to two main factors.
The first one is frictions, is the costs of active management, transactions cost, inefficient investment in terms of taxation. So, very heavy turnover that generates a lot of taxes every year. So frictions is one. And the other one is really our own self-inflicted problems, the way that we manage the money ourselves.
How much damage then are those two things causing to our investment returns? Well, using actively managed funds instead of low-cost index funds will cost you an extra 1.5%, maybe up to 2% a year. But bad investor behaviour, particularly chasing performance, is even more costly than that.
A number of different researchers have analyzed those numbers, and what they generally look at is what's called investor returns and fund returns. So they look at, if you invested $1 in a particular fund, what the return would have been if you just kept it in the whole time, and that's called the fund return. And they compare that to what they call investor returns, which is they look at the cash going in and out of each fund and look at the internal rate of return or the return on that. Well, guess what? They find 3% is very often the difference between the fund return and this investor return, which is huge.
In conclusion then, keep your costs low. But even more importantly, manage your behaviour, preferably with the help of a financial advisor who understands you and what sort of person you are.